Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Internal Risk Controls. Internal risk controls are an essential aspect of corporate risk management, playing a crucial role in safeguarding an organization's assets, ensuring compliance with laws and regulations, and enhancing the reliability of financial reporting. The effectiveness of internal risk controls directly influences an organization's ability to achieve its objectives and maintain operational integrity. Internal risk controls can be defined as processes and procedures implemented by an organization to identify, assess, manage, and monitor risks that could potentially impact the achievement of its objectives. These controls encompass a wide range of activities, from segregation of duties to the implementation of robust information systems, and are designed to provide reasonable assurance regarding the effectiveness and efficiency of operations, the reliability of financial reporting, and compliance with applicable laws and regulations. One of the fundamental principles underpinning internal risk controls is the concept of segregation of duties. This principle dictates that no single individual should have control over all aspects of any critical transaction or process. By dividing responsibilities among various employees, organizations can reduce the risk of errors and fraud. For example, in the context of financial transactions, different individuals should be responsible for authorizing transactions, recording them, and handling the related assets. This separation creates a system of checks and balances that enhances the accuracy and integrity of financial records. The implementation of robust information systems is another critical component of internal risk controls. Information systems facilitate the accurate and timely processing of data, which is essential for effective decision-making and risk management. These systems should be designed with built-in controls to ensure data integrity, confidentiality, and availability. For instance, access controls can be implemented to restrict unauthorized access to sensitive information, while encryption can protect data from being intercepted or tampered with during transmission. Regular audits and reviews of information systems can help identify vulnerabilities and ensure that controls are functioning as intended. C. Internal risk controls also involve the establishment of policies and procedures that guide employees' actions and decisions. These policies and procedures should be clearly documented, communicated, and enforced to ensure consistent and compliant behavior across the organization. For example, an organization might implement a code of conduct that outlines expected ethical behavior and provides guidelines for addressing potential conflicts of interest. Regular training and awareness programs can help reinforce these policies and ensure that employees understand their roles and responsibilities in maintaining a strong control environment. Monitoring and reviewing internal risk controls is an ongoing process that is critical to their effectiveness. Organizations should establish mechanisms to continuously assess the performance of their controls and identify areas for improvement. This can be achieved through regular internal audits, which provide independent assurance that controls are operating as intended and that risks are being effectively managed. Additionally, organizations can use key risk indicators to monitor risk levels and trigger corrective actions when necessary. For example, a sudden increase in the number of exceptions or deviations from established procedures might indicate a potential control weakness that needs to be addressed. A case study that illustrates the importance of internal risk controls is the financial scandal involving Enron Corporation. Enron's collapse in 2001 was largely attributed to the failure of its internal risk controls, which allowed senior executives to engage in fraudulent accounting practices and conceal the company's true financial condition. The lack of effective controls over financial reporting and the absence of independent oversight contributed to the company's downfall, highlighting the critical need for robust internal risk controls to prevent similar incidents. The effectiveness of internal risk controls is also influenced by the organization's risk culture. A strong risk culture promotes transparency, accountability, and a proactive approach to risk management. Organizations should strive to create an environment where employees feel comfortable reporting risks and control deficiencies without fear of retaliation. This can be achieved by fostering open communication, encouraging ethical behavior, and providing incentives for employees to act in the organization's best interests. Leadership plays a pivotal role in shaping the risk culture by setting the tone at the top and demonstrating a commitment to robust risk management practices. Statistics underscore the importance of internal risk controls in preventing financial losses and enhancing organizational performance. According to a study by the Association of Certified Fraud Examiners, organizations with strong internal controls experience significantly lower fraud losses compared to those with weak or non-existent controls. The study found that organizations with effective controls detected fraud more quickly and incurred median losses of $100,000 compared to $200,000 for organizations with inadequate controls. These findings highlight the tangible benefits of investing in robust internal risk controls. In conclusion, internal risk controls are a cornerstone of corporate risk management, providing a framework for identifying, assessing, managing, and monitoring risks. The principles of segregation of duties, robust information systems, documented policies and procedures, and ongoing monitoring are essential components of an effective control environment. Case studies such as ENROLL and empirical evidence from studies like those conducted by ACFE underscore the critical importance of internal risk controls in safeguarding organizational assets, ensuring compliance, and enhancing the reliability of financial reporting. By fostering a strong risk culture and continuously evaluating the effectiveness of controls, organizations can mitigate risks and achieve their strategic objectives. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us, and we look forward to supporting your continued pursuit of knowledge.